John, after a big year in the stock market last year, you said at the start of the year that you wouldn't be surprised to see some sort of drawdown. But who would have thought that we've actually seen the worst start to a year on the S&P 500 since 1939? So we've talked about how we got here, the Ukraine war, higher interest rates, and so on. We don't necessarily need to delve into all of that, but where do we stand and where are we going and what's happening right now?
I think that what we're really doing is we're going through a valuation correction. There's been arguments, are we going to have a recession? How high are interest rates going to go? The bottom line is I think we're going through a good old-fashioned 1987 type correction in valuations. Investors are reassessing how much they want to value profits at. And so it's very interesting because things look pretty decent out there, other than there's a war going on in Europe, but things are pretty good. And we're seeing profits are actually increasing at a fairly decent pace. So investors are reassessing what the future looks like, and we're going through a valuation correction. Not all that unusual.
You used the word decent. That's the word I was going to use to describe the economy. We can cherry pick some good economic numbers, some weak economic numbers, but let's just say it's decent. But we have seen investor sentiment really sour. In fact, the worst in decades. So why the disconnect?
All kinds of investors have different attributes, time frames, and objectives. And I think that the average investor has been paying so much attention to how much is the Fed going to raise interest rates, when are they going to raise, by how much. We've all talked ourselves into this deep depression. We had very, very strong numbers. I think a lot of people thought, like we did at the end of the year, that, wow, that's been pretty good for a couple of years. Very surprising, and that we're having to reassess things. And I think people have been sort of pessimistic based on what's been going on in the world. Profits are going up. The economy is pretty strong. Full employment. People are making more money. Savings rates are very high. And investors are pessimistic. And I don't really know what's going on. I just think that they're reassessing things, and they've got themselves talked into a period of pessimism. The markets are driven by two primary drivers: fear and greed. We've had a lot of greed and a lot of optimism recently in the last couple of years, which was surprising considering all the negative news. And now we have a lot of good news out there, other than a war going on in parts of Europe, and people are pessimistic. And I just think that we have to go through these periods where you go from optimism to pessimism, and that's what really creates the opportunities.
So a lot of optimism created the bubbles that we saw that mostly ended in 21. We don't need to list them, but stocks and NFTs and crypto and SPACs and so on. And usually when we see bubbles unwind, just when we think, oh, it looks like it's over, it gets worse and it cascades lower and gravity works its course. Do we need to see more pain and gravity to work some more? How do you assess where we are now and how much more pain is to come?
I don't think we're there yet. They tend to be very emotional, and oftentimes emotions don't last very long. We're getting close. I mean, the sentiment numbers, as you said earlier, are very, very bad. That tends to mark bottoms. But, you have so much trading going on these days, which is run by computers, which are mindless, thoughtless, and they don't care what the price of a company's worth. They just buy and sell things. They could be trading tomatoes for all they care. And so those computers can take things to crazy valuations. Zero. I mean, we had oil prices traded at zero in 2020. Actually, negative numbers. So you don't know how far things can go when it gets emotional. It's getting emotional. You do know that companies are trading 20, 30, 40, 50, 70% cheaper than they were 6 months ago or a year ago. So if people liked them 6 months ago, 30% more expensive, and they thought they were good businesses that had optimistic futures 5 years down the road, then there's some fantastic deals out there right now.
And that segues into what you do for a living, managing money. I know you've been making some changes. You've talked about buying dips and selling rips. So what kinds of incremental moves have you been making in your portfolios?
We did a little bit of trimming at the end of the year. We put some hedges in place to protect ourselves against a potential downturn. That's played out a little bit. We've had new clients come in, so our cash is really built up that way. We did do a little bit of selling when the market first bounced back after its March lows. Things are changing a little bit, and we're always wanting to be attuned to situations, but mostly we've done nothing. And just sort of like the cash is kind of built up. We have recently bought a new REIT called Dream Residential REIT, which owns multi-residential buildings in the States. And one of the biggest components of inflation out there has been rents in the States. It's been growing at 9, 10, 11%. So for clients that are looking for income, here you have a REIT that's paying you in US dollars, 3.2% or so. And those rents, and it's very underlevered, the REIT's very strong financial shape, huge opportunities to buy things at 6, 7% cap rates. And they should be able to boost those rents at around 12% per annum over the next couple of years. So that's kind of an inflationary hedge. So that's really the only major thing we've done recently. But we're getting ready here in the very near future to go all in and start putting client portfolios back to work again.
So looking 3 to 5 years down the road, as you usually do when you're looking at buying companies or holding them or selling them, are there any companies that you own or any companies that you like to own that are just screamingly inexpensive right now? They may not quite be the right time to buy them yet, but they look really attractive.
Increasingly, there's more and more of them every day. People have been throwing things out with the baby in the bathwater recently. I think the bank stocks in the States look really, really compelling. We're not calling for a recession the next year. Default rates are very low. Consumer spending is really charging up here. Consumer installment debt's growing. That's good for the banks because banks make money lending people money, and consumers are in very strong shape in the States. Bank stocks are yielding 3.5% or so. That's very attractive compared to where 10-year Treasury bonds are at about 3%.
Sorry, not to stop you there. What's your favorite? Bank of America?
I think Bank of America, JP Morgan, and PNC Bank are outstanding. They're all a little bit different in the things that they do. They're trading at around 10 times earnings. The market's at around 17 times earnings. All the problems that people worried about a year ago have really gone away. The banks are able to charge higher and higher interest rates. And we don't expect delinquencies are going to go up because, as I said, American consumers have very high absolute savings rates, and that's a positive for the bank stocks. So I think banks look like outstanding value. I think, Google is trading at around 18 times its earnings. That's the same multiple as the market, and yet it's growing way, way faster than the average company. Apple represents excellent value, I think, here. Amazon trading the cheapest it has on an EV to enterprise basis since the last 15 years. And, people are worried, it's not growing at 50% like it did last year. Well, for goodness sakes, it's got $500 billion in sales. That's up from, I don't know, let's say it's up from $400 billion in sales the year before. Those are huge COVID-boosted sales. So in some respects, these companies are suffering from unrealistic expectations that COVID-type growth could keep fueling their growth forever. They're still growing, but based on what they did last year, it doesn't look as good.